Onto some company news now. Property companies are still taking a hammering from the COVID-19 pandemic. Redefine Properties' half-year earnings fell by around 62.7%. The owner of retail offices and industrial properties says that it saw a decline in its revenue during the second half of 2020. It's flagged the deconsolidation of its European logistics investment and the sale of its student accommodation in properties in Australia and other non-core local properties, also negatively impacting revenue. The company has deferred the decision on a dividend payment until the announcement of its full-year results. And joining me now to talk more about this is the Chief Executive, Andrew Konig. Thank you very much for your time this evening. I mean, despite a decline in earnings, there were some milestones in terms of the reduction of debt for Redefine.
Absolutely, and good evening to everybody. We have made great strides in improving our balance sheet risk through a deliberate process of disposing of non-core assets. During the period ended 28 February, we realized about 4 billion rand of assets that we disposed, and we've got another 4.8 billion rand of assets that are in the process of being disposed in the second half of this financial year into the early half of the next financial year.
Right, all the cash that you're going to be getting from these assets that you are getting rid of as a business, where is that capital going to be reinvested into as a business?
At this point, the most productive way of deploying that cash is to repay existing debt, and we are in the process of reducing our debt level so that we are able to reduce our balance sheet risk as a consequence.
Right. One of the things that Redefine is having to do is to really change with the times. The pandemic has completely changed the way things work. The work from home phenomenon is growing. And just talk us through the initiatives that the business is taking on in terms of investing further in logistics, for example, and some other avenues that Redefine is going to look for some growth in revenue.
So e-commerce as well as logistics refinement is what's driving demand for logistics property here in South Africa, as well as in Poland, where we are also invested. And that will be an area of expansion going forward. We do not believe that the office or the retail properties that we own are dead and buried. In fact, we believe they're in hibernation, undergoing a metamorphosis for better things to come. We all know that we are wired to be social creatures, and once we have our pandemic under control through a successful vaccination rollout, we believe that there will be a return to mobility in both the retail and the office sectors, which will mean a resumption of take-up once again.
Right, and as you say that, it is reflective in your numbers. There was a renewal of leases, but obviously they're not at the same scale as pre-COVID-19 in terms of the space that businesses and other people come through to look for when they come to Redefine.
I think the space isn't the issue at the moment. It's more about the rate per square meter, where we're seeing that leases that are coming up for expiry are being renewed at rentals lower than the expiring rental. And that is a consequence of excess supply at the moment, as well as demand that is similarly quite low. So you're getting a perfect storm, which is good for the tenant from a negotiation point of view. We don't believe that that is a permanent situation. It's a cycle we find ourselves in. And once we are back into an upward economic cycle, things will turn.
That is Andrew Konig, who's Redefine Properties CEO, saying that the tide will turn and the market will get better.